Okay, well, good evening, everybody, and welcome to another one of our educational sessions here at Level Financial Advisors. I'm Mike Hebron, the Chief Operating Officer and one of the partners here at the firm. And tonight we're going to try to do something a little bit different, something we've never tried before. And it's called Ask the Experts. And hopefully we'll be able to do these on a more regular basis. We get a lot of questions from our clients across the country, giving us asking us different things about the economy or their portfolios. And so tonight's session is dedicated to that mailbag type of response. What we're hoping to do here is answer some questions that were sent to us in advance. And then, of course, if anybody here on the webinar has questions to ask, we encourage you to use our Q&A function, type in your question, and we'll interrupt the presentation at some point and ask your question of our experts. And tonight, I'm happy to be joined by Wes Crill, who is the head of investment strategist and a vice president at Dimensional Fund Advisors. As a member of the investment solutions group, he directs empirical research on a broad range of investment topics to support client relations. A frequent speaker at Dimensional and industry events, Wes is responsible for developing investment content, analysis, and education that is distributed across a variety of platforms. Wes has earned a BS and a PhD in materials science engineering from North Carolina State University. So Wes, welcome into the forum. You're on the hot seat. I also have on standby Paul Coleman from our firm in case we get any firm related questions. So let's, there's Paul. Paul's going to chime in and say hello. And here we go. We're going to go right into the content. Let's start with our first question, and I'll just go right into it here. First question we received is, I heard the yield curve inverted, and that is supposed to be bad for the economy. What does inverted mean? And does it guarantee we will have a recession?
Yeah, sounds good. And by the way, thank you all for having me tonight. And I'm glad everyone could join. It's great to be part of the first one you do of this Ask the Expert series. Hopefully you don't abort the series after my performance. So hopefully this will be a good session tonight. So let's go ahead and start off with the first part of this question. And basically, what do we mean by an inverted yield curve? That's pretty simple to show with the picture. And in fact, we have a first slide in here that I think will be useful to kind of convey what we mean by that. If we could jump ahead one slide, please. There we go. So what we're looking at here are two different yield curves for U.S. Treasuries. So these represent the yield on U.S. Treasuries at varying maturities. You can see as you go from left to right, and you're going from 1 year for maturation all the way out to 30 years. And we're showing this curve at two different dates. Now, the gray dotted line is the end of 2021. So December 31st, 2021. The blue line is where the Treasury yield curve was at the end of March. And what we generally expect to see from yield curves is more like what the December end yield curve looks like, something that's mostly upward sloping. So that means that you expect to receive higher yields at longer maturities. And this is consistent with intuition, right? So if you think about, when you're investing in bonds, you're essentially loaning money out, in this case, to the US government. And the longer out the repayment is for the loan, the higher the level of interest rate you would generally expect to receive for the loan, all else being equal. So that's why we expect to see upward sloping yield curves, and that's how they are about 90% of the time. Now, as you can see by the blue line there, that's not exactly what we saw, what we've seen more recently, where you have this kink over in the shorter period, about the 2 to 3 year maturity segment of the curve, where because that portion of the curve has risen, you see that there's no longer that positive slope. And in fact, the inversion means that that 2 year segment actually has a higher yield than the 10 year. That's a traditional way to measure the term spread. So when people say yield curve is inverted, what they often mean is that the 10-year yield is no longer higher than the 2 year yield. So somewhat unusual shape for many investors to see this. So then the question is, well, what does it mean? Now, there have been predictions, and there's been people in the past who said that yield curve inversions were always precursors to recessions in the US. That does happen to be the case historically. The problem is you have a sample size of about 3. So we haven't had a ton of inversions. And when they have occurred, they have been followed by recessions. But does that mean we should expect that no matter what? That's a harder question to answer. If I'm an investor, what I really care about is what is it going to mean for the performance of stock markets? And that's where we have some good news. And in fact, when we move to the next slide, we can show you another picture, which has been what has been the performance of stock markets following yield curve inversions. Now, I already mentioned we only have a handful of these in the US, 3 of them, in fact, the last one being back in 2006. But we can expand this globally and look to see, okay, if we look at different countries, what happened when there was an inversion between the 10-year and the 2-year bonds of that country? What was the performance subsequent to that for the stock market in those countries? And you can see, when we plot out the growth of wealth for all of these different instances of yield curve inversions, and we have a sample period going back to 1985, you can see that it was sort of a mixed bag, but more often than not, after 2 years, 3 years down the line from that yield curve inversion, the equity markets had delivered positive returns, about 2/3 of cases actually. And in fact, if you were just to look at, what is the unconditional probability, if I look over any 3-year period historically, the stock market's performance, how frequently was it positive? That 2/3 frequency there is pretty close to what you see if you just look over any given 3-year period. So yield curve inversions, somewhat unusual, but in terms of what they mean for stock market performance, does not seem to be a predictor of market downturns. In fact, more often than not, markets have been up over the subsequent period.
Okay, great. Okay, here's the next question we've queued up from the mailbag. So, is the United States headed towards a recession?
Yeah, I guess this
bring
is
out your crystal ball. Yeah, get your crystal ball out. And what are your thoughts on this?
Yeah, well, it's funny you mentioned crystal ball because, I've already sort of dismissed one supposed predictor of recessions. It's when you look at the National Bureau of Economic Research, or NBER data, which is, generally the definition that people use for where we are in the business cycle, and they will mark where the recessions have been historically. Even with the benefit of hindsight, they sometimes have difficulty figuring out what was the onset of a recession, and it's even subject to revisions. So even with the benefit of hindsight, if they can't make a precise determination of when a recession began, I think it's very challenging for investors to really say, and even strong economists to figure out when a recession is going to take place. But let's say, just for the sake of this conversation, that we are headed into a recession. Again, I go back to, what do I care about if I'm an investor? Recessions are associated with decreases in GDP growth or contractions in GDP. They are not associated necessarily with market downturns. And that's something we can see using a similar kind of analysis as what I showed you on a previous slide. We can look at the growth of wealth for the stock market. In this case, we have a decent number of observations in the US historically. And we can look at the growth of wealth in this next slide in periods following when we've had recessions in the past. So you can see, if you start at, we'll just call it T = 0, the 0-month period here on this chart would be when the recession starts. And if we look at the next 24 months after the beginning of that recession, more often than not, in fact, about 75% of the time, you've had positive stock market returns during that period. And I think this comes back to really just how forward-looking markets are. So markets are always take into account what's happening in the economy, what they expect to be the impact on different companies and their expected future cash flows. And in fact, what we see in the data traditionally is that rather than recessions or GDP growth predicting stock market performance, it's the other way around. If you look at lagged stock market performance, that tends to be the best predictor of future economic development. And I think that's part of the reason why you see the result here. Typically when you have a recession, the impact on stock markets is baked in very early on, if not before the actual determination of the recession. And so at that point, it's almost too late to do anything about it. And the reason why I mention it in that context is, we've seen what happened in the stock market at the beginning of this year. If we were in fact about to go into a recession, it could be, I'm not saying definitively, it could be the case that the market's reaction to the worsening economic condition has already occurred. And so at this point, we could have a strong return going forward. And it just really kind of depends on what else comes down the pipeline. But if it's the market's expectation we're going into a recession, we would expect that the market's impact has already been felt and we could have positive returns from here.
So Wes, real quick, anything to the fact that two of the last two recessions, I think if I see on this chart correctly, have resulted in negative results after month zero. Anything to that? Anything that's changed in the markets in the last 20 years that would cause that?
Well,
it's just something that sticks out from the chart when I look at it.
Yeah, no, and actually I hadn't even noticed that one before. But in fact, if you add on the most recent one from 2020, so that would be one out of the past three, we've had really strong market returns if you were to run this kind of analysis and throw in the one from February of 2020. So I think it's one of those things where, just kind of luck of the draw for those periods, or unluck of the draw, as it were. But I think the same principle applies. We expect markets are going to be forward looking no matter what. And I think this just kind of comes back to economic conditions. And if the market is baking in an assumption that we're in for rough sledding for the economy, the equity premium has to be positive on expectations at all time. Market participants are not going to sign up for investing in stocks if stock prices are not set at a level where they're getting a positive rate of return and a premium over fixed income. Otherwise, the market is just not going to clear. And the way you can think about that is if the market is expecting a rough economic climate over the next, 6 to 12 months, if that does come to pass, then guess what? If that was the assumption, you can still have a good outcome from markets. So I think that's something always to keep in mind about the forward-looking nature of stock markets.
Okay, great. Okay, so let's move on to the next one here. Much of the talk about rising interest rates is all the bad things that it means for bonds, the housing market, and the economy. Is there any good that comes from higher interest rates for me?
So here it's interesting to kind of disentangle the rise in the rates from just a high level. So we know that a rise in rates, all else being equal, will have a negative impact on bonds because bonds, prices and yields in bonds are like a seesaw, where when yields go up, which is what people are talking about with rising rates, prices are going down. So the prices of the bonds in your portfolio are decreasing, which again, all else being equal, would signify a negative return. But once they're high, then that's not necessarily a bad thing for investors. Now, for the economy, it acts as sort of a speed bump because it reduces the amount of available money. And that's why things like getting a mortgage for a home becomes harder, getting a loan for a business for some sort of investment becomes harder. But high interest rates, specifically if they're real interest rates, and I'll get into what I mean specifically by a real rate, but high real interest rates are good for investors because that directly impacts the rate at which they're able to grow their wealth. It factors into what the forward looking, so at this point in time going forward, what is the expected return for holding bonds? It also plays a role into the discount rates that are used for expected future cash flows in equities. So the higher the interest rate, all else being equal, the higher the expected return on stocks as well. Now, it is important, to distinguish between that nominal interest rate and a real interest rate. So the difference between the two is reflective of inflation. There's a proxy we often use, which is called break-even inflation. It really just means the difference in yields between Treasury inflation protected securities, or TIPS, and nominal government bonds of the same maturity. So if I'm looking at a 5-year nominal government bond, a 5-year TIPS bond, the difference in those yields is instructive about differences in inflation. If only the nominal yield goes up, then it doesn't mean that real interest rates have gone up. It could just mean there's higher expectations for inflation. While there are higher expectations for inflation now, that's something we see in the data, not exceptionally high, but higher than it was about 12 months ago. Real interest rates have also gone up. So that means that to the extent that those are associated with higher expected returns, it makes it even more likely that you can reach your investment goals when those rates are high. So while the mortgage gets more expensive, funding a purchase in the future might get a little bit easier.
Okay. All right, great. Moving on to our next question. It seems like all the headlines are negative right now. Why shouldn't I just sell now and wait this out? And we get some of this, people calling up saying, oh my goodness, the the sky is falling, get me in cash. So what do you say to this type of sentiment?
Yeah, it's funny. I can't even remember a time where the sky wasn't falling. And, I've only been in this business for 12 years now, but it has just seemed like a never-ending stream of tumult in financial markets. But yeah, certainly there's been a lot of stuff going on in the past couple of years. It's probably noticeably negative for many investors reading the headlines. I think the first place I would start, and this is just sort of a philosophical framework. If you were to think about two different states in the world, there's a good state where things are all hunky-dory, markets are relatively placid, not a lot of bad news, versus a bad state where, let's say that's how you describe what's going on right now. In which one of those states do you think expected returns are going to be the highest? Now, theory would tell us that the expected returns have to be higher in poor states of the world. Why? I need more of an incentive to invest my money when I feel like there's a strong possibility I'm going to need that money for something right now. We know that periods of economic upheaval are associated with greater likelihood of losing a job or having a reduction in my bonus. And so I'm more sensitive to the money I have right now. I'm less likely to want to invest it. And so markets need to offer me a higher rate of return to induce me to invest. So what that tells me is if you think uncertainty is particularly high right now, that probably means expected returns are higher on the table going forward. Now, in practice, there's no evidence that people can actually properly time or figure out when these things have really changed. And then it becomes really just a question of, do you feel like you can time markets? The empirical evidence, decades of academic studies are not kind to market timing strategies. Trying to sell out of markets when you sense uncertainty means that you really need to know, number one, what's the bottom going to be for the market? How long do I stay out? What's my rule for getting back in? Those timing decisions are very easy to get wrong, and they can be very costly for investors' long-term returns. And then I keep going back to this notion that the expected return for stocks cannot be negative. They have to offer a premium over fixed income in equilibrium based on what we know right now. Now, that doesn't mean you can't have a negative return from stocks, if there's changes in the information that's available or something else bad happens. But based on what we know today, all the negative headlines you're reading, even taking those into account, markets are offering a positive expected return on stocks. And that's something we want to be able to take advantage of, because missing out on when that premium is delivered can be a real impediment to us reaching our long-term goals.
Okay, great. All right, moving on to the next question. How will the recent spike in inflation impact my portfolio?
Well, the bad news is the one that's in the rearview mirror. There's really nothing we can do about it at this point. But the question becomes if inflation is here to stay. If we're looking at, not that it would be 8% or whatever it's been over the past year, but if it continues to be high in the future. Now, the first place I would look, I mentioned earlier that data point we have called break-even inflation. So the difference between the inflation protected and nominal yields. For the 5-year treasuries, it's about 3.6%, at least it was a few days ago. What that number tells you, the difference in yields, is more or less an approximation of what the average inflation is expected by the market as a whole, all infinite market participants that are trading. This is their expectation for average inflation over the next 5 years. So 3.6%. Not as low as what we've become accustomed to over the past 20 years, but not exactly like Weimar Republic hyperinflation. So, not a runaway figure there, but higher than what we've been used to. Now, in terms of what that would mean for investments, we see historically that most asset classes have had positive real returns, even in high inflation periods. So if I look at stocks, at corporate bonds, they have had higher returns than inflation, even in so-called high inflation periods. So if my goal is to outpace inflation, I might not need to do anything, especially if it's going to be somewhere around 3.6%. Well, the historical rate of return on stocks, let's just call it a conservative 6%. You're still going to be outpacing inflation. You're still going to be moving in the right direction towards your investment goals. And it's also important to remember that expected inflation, which is what we're really talking about here, if the market's expectation is 3.6%, that's going to be incorporated in current market levels such that expected returns are at a level to offset, to compensate you for that expected inflation. So expected inflation is really not something that as many investors are going to be as worried about. Unexpected inflation is something that many investors are going to be concerned about. Unfortunately, because as the name suggests, it's unexpected, we really don't have a way to predict when that's going to occur. Now, there are inflation protected types of solutions out there. You can use TIPS, you can use inflation protected corporate bonds, and there are ways to mitigate the impact of unexpected inflation. But if I'm just looking at where the market is sitting today, it doesn't really seem like there's a big need for investors to make big changes if they're invested in asset classes that can outpace inflation, like many traditional stock and bond asset classes have done.
Okay, great. All right, let's move on to the next question. Oh, okay, there's a chart there. Did you want to speak to that, or is that just more of what you
Oh, yes. Yeah, I almost forgot I had a picture to go along with this. Yeah, so this is what I was talking about where, okay, what does inflation mean for a portfolio? You can see the US stocks on this chart here, and clearly there's a lot of variability because, it's an equity asset class. They've been able to handily outpace inflation. And it's not just over this period where you've had relatively low inflation, except for that 2021 bar there. But even going back to 1926, if you just divide up all the calendar years going back to 1926, the S&P 500 has had a higher average return than the average change in CPI. So the real return on stocks has been positive. And again, this is why we think about the role of, whether you would need to have an asset allocation change based on inflation. Kind of depends on where you are in terms of just your overall asset allocation goals. If you are maybe a little bit more towards the risk averse side of things, and maybe you have a lower allocation to equities in your portfolio, you might already be kind of prioritizing reducing the uncertainty over the value of your future wealth. That's what fixed income does very well. And so reducing the real value uncertainty of that in the future with something like inflation protected fixed income can make sense. But again, if you have a decent slug of equities in your portfolio, this picture tells you everything. Equity returns can dwarf inflation over the long term.
Okay. All right, next question. Why is the bond market down so much?
Well, the bond market's down in terms of prices because the yields are up. It's like I mentioned earlier, you have a seesaw there where when one goes down, the price, that means it's because the other side of the seesaw or the yield went up. Now, it's important to point out that it's not every point on the curve. It's not every maturity of bond that is gone down by the same amount. And in fact, there's this concept of duration that tells you about how much the price of a bond will go down depending on how long its maturity is. The simple analogy that I sometimes use for this is, if you think about a diving board. A diving board is telling you something about the duration of a bond. It's analogous to it where if I have someone that is standing all the way at the end of the diving board, so they're as far away as they can get from the mounting point of the diving board, that diving board is going to flex more so than if that same person walks on the diving board and stands closer to where it's actually mounted in the ground. So the shorter the bond's maturity, the less its price moves. And the reason why that's relevant is because when people talk about, rates went up and so bond prices went down. Well, that's true, generally speaking, but the extent to which it impacted your portfolio might not be as much as what people are talking about when they're maybe quoting, much longer dated bonds. So it's something to keep in mind. And again, I go back to this notion that, I think the broad market treasury indices were down about 5% for the first quarter in 2022. That sounds like a lot, not the largest downturn we've seen from treasury markets. There have been some even larger quarterly downturns historically. But if you think about what the range of outcomes has been for equities, a quarterly downturn of 5% would barely move the needle in historical data. So I think that's indicative of the fact that even in a down market for fixed income, it still does its job. It is still a superior way to provide a ballast for the value of a portfolio to help mitigate downturns, because if that is considered a right tail event, that's still something that can help protect investors from an even bigger downturn, which is something we would expect of equity markets on occasion.
Okay. All right. Our next question. The stock market started the day down, but then ended the day up over 1% the day that Russia invaded Ukraine. How is that possible on a day with such terrible news?
So these are always challenging questions to answer because there are so many things that markets take into account. One of the things I oftentimes will go back to is the simplest example is in fixed income markets, where the Fed can directly control what's called the target funds rate. So the very short end, essentially, of the yield curve. The Fed has raised their target funds rate in 70 different months going back to the early 80s. So you think, okay, if the Fed raises that interest rate, you would expect that the yield curve for treasuries would follow suit. But in fact, when we look at 10-year treasury yields during those 70 months, those 10-year treasury yields have actually gone down about a third of the time. And what that tells you is that even in something that seems to have a very straightforward cause and effect, a very clear link between action and consequence, it hasn't been as clear cut because there were so many different market forces that impact the yields on 10-year treasuries. The stock market becomes even more complicated than that simple link between those treasuries, just because there's so many different ways that a company's cash flows can be impacted. And that's going to factor into stock prices in just a very complex way. And so that's one reason why you might read one headline that sounds really bad, but the market might be baking in tons of other things. Maybe there was news about virus counts that day, or infection counts, or maybe there was some news about pharmaceutical delivery for for the vaccine or for other treatments. And maybe there's some shred of good news on that same day that maybe could outweigh what was going on with Ukraine. And then again, I go back to the notion that the markets are very forward-looking. The day that Russia invaded Ukraine was not the first day that markets got an inkling that there was going to be some conflict there. So if they thought the day before that there was a 99% chance of that invasion happening in the near future, the fact that it happened on that day might not be enough to move the needle because markets had already priced in that event. So this is why it's so challenging to outguess markets. Even if you told me with perfect foresight what the news was going to be the next day, I still might not be able to outperform markets because it might not be foreign enough of a concept to markets themselves.
Okay, great. All right, let's keep going here. Do you think the Fed raising rates will actually bring down inflation?
That's another really challenging one to answer, and I don't think they know the answer to that question. I think that's the hope, is that this tool they have of changing the federal funds target rate has that impact. And broadly speaking, I mean, directionally, you expect it to work, right? If I raise interest rates, what does that do? Well, that potentially lessens the amount of capital there is to deploy in the economy. And if there's less capital to deploy in the economy, then there's less pressure on prices. That's the mechanism here that they have put in place. That is one of the few tools they have to actually control inflation. But again, it's going to be a function of lots of different things. You're going to have just the supply chain itself can impact prices, even if there's not more money chasing after goods and services. If goods and services become more scarce, and that same amount or even less money chasing after them can still have a big impact on the prices. So it's not totally clear, and it is a challenging thing, because what you don't want to be in a scenario of is where you have very high inflation combined with very low or even negative economic growth, and so-called stagflation. I know that's something economists often worry about. But even then, we see historically that when you have periods of stagflation, as rare as they are, you still have good stock market performance. And that's the thing I keep coming back to. If I'm an investor, what I really care about is, maybe I care about the economy to the extent that it impacts my quality of life, but mainly I'm thinking about what's going to happen with my investments. And there, it's not so clear cut that the success or failure of the Fed's tools will impact my investments.
So here's a follow-up question to that. There's some talk out there that the Fed waited too long to raise interest rates. Any thoughts on that? And what's that question really trying to get at here? I've heard that question several times now in the last couple of months, that they waited too long. They I guess misguessed when they needed to do it. Any thoughts on that?
Well, it's a challenge for them because, yes, I mean, if you wait too long, then inflation can kind of keep going and become sort of a self-fulfilling prophecy there, and you might not be able to control it. But then if you do it too early, if you were to cut rates too early, they don't have a tool that works on the negative side because there's a zero bound on their target funds rate. They can't take the target funds rate negative. And so they really don't have something that can effectively curb deflation if you were to have that running away. And that's something that can be just as deleterious for an economy as really strong inflation. And so it's a challenging thing. And I think at the end of the day, they're trying to do what they think is best for the economy. I'm not an economist. I'm certainly not going to try and offer a really robust evaluation of whether they timed it correctly or not. I think that even if they get the timing wrong, I think the nice thing for investors is that it's very likely that they're not going to have to make any adjustments in terms of their portfolios, that they're still going to be okay, even if there's some things that are worthy of criticism on the part of the federal government.
All right. All right. So let's say, I think that was it. I think those were all the questions that we had, Wes, and I'm just going to see here if there's anybody else online that has any other questions coming in. Looks like we went through that material pretty quickly. So, and I don't see any other questions. So I think what we'll do here is we'll just wrap, we'll wrap a little early. And I want to thank you, Wes, for taking the time to come in and share your thoughts with us. And thanks for everybody who joined online. We're, like we normally do for these educational sessions, we will put the content up on our YouTube channel. I invite everybody to subscribe to that channel. You can look us up on YouTube. Just look for Level Financial Advisors on YouTube. And we'll blast this out to everybody here in the next day or so. And in the meantime, if you have other questions or you have questions that come to mind after this presentation, you can always email us at invest@levelfa.com. Send us that email there and we'll get somebody back to you with an answer. So until then, thanks everybody for joining and have a great night.